Hey, everybody. Welcome to the podcast. Thanks for joining me. Appreciate it. Kind of doing a rare intraday podcast. It's actually almost about 9 o'clock. The market's been open for about 30 minutes now on this Thursday morning. And just came out with the Chicago PMI, which is another economic indicator, and it was roughly 55, we'll call it. The estimate was for 50, and this is one of those numbers that above 50 shows expansion, below 50 shows contraction. And this helps the bears that were looking at that GDP number from yesterday and said, boy, the first contraction since the Great Recession, this economy stinks. This says, well, maybe that was just a blip. Let's take a look at some of these other economic indicators. So, the market spiked a little bit. But look, I've got a picture of the S&P. And again, this podcast is going to be kind of short, but I just wanted to touch base, let you know. I've been taking a few profits the last few days on some shorter-term trades, some little more aggressive things that just looked overbought. But I'm actually looking to get more invested in this market on pullbacks, and I think a lot of people are, and that's why sometimes strong markets don't let you in, they say. So again, if you're in that situation where you have way too much cash, probably averaging in isn't a bad strategy, or just waiting for a pullback if you can. But the thing is, look, the S&P obviously broke out earlier this year on the fiscal cliff, settling that, at least for now. We got the sequestration potential on March 1st. But look, I got a picture of RSI, which is a technical indicator some of you may use already. It's a good kind of a guide. It doesn't always exactly work all the time, and sometimes you can get caught doing things like, for example, right now it's up at this high level, so you would sell and say, well, when it comes back down here, I'll buy. And that worked great in September, all the way past the election. But there are times where it'll just hang out up there for a long time and the market just keeps going up. So be careful, but I point out that, yes, it's in the quote-unquote overbought territory. I've got several indicators that are also pointing towards an overbought market. Very close to September, not quite as stretched as September was back here, but very close. And so, we're starting to see some cracks. I mean, some of these stocks that were just racing up, heading down. Now, if we look at things like the transports, had a big down day yesterday. Remember, they'd been the strongest group coming out of this breakout, this little sideways pattern they'd been in for most of 2012. They broke out, pulled back a little bit, and then off to the races, and it's been up every day. Well, yesterday was probably the first day we saw real substantial selling in this that looked legitimate. But that doesn't mean the run's over, but it did say that a lot of stocks were looking that way, where they were just overbought. And so again, you saw a little pullback yesterday, nothing significant, but it seemed magnified given that we hadn't had any type of correction like that this whole year. But what's going on is, look, we had this GDP number, which was negative yesterday, supposed to be positive. Some people blame it on the weather. I think a lot of this had to do with the fiscal cliff. I think we did see personal spending, consumption higher. So you're going, well, it doesn't seem like individuals were really paralyzed by the fiscal cliff. They kind of talk like they were, but the stock market was going up, consumption was good. What is it? Well, it was businesses. There was a cut in defense spending. Obviously, with the winding down of the wars, there was the biggest drop since 1972 on defense spending. But I really think businesses were the ones paralyzed and holding back and not spending. And so you saw this contraction, and now I think you're seeing that money get freed up. We're seeing capital expenditures go up. So I think it was just kind of a pause more than a number that gets me worried. I will say, if that trend continues, obviously the market's going to go down, because what we know is that the stock market is very responsive to how fast the economy is growing, but not just how fast it's growing, but how is that growth accelerating? In other words, is it growing at 3% and then it goes up to 4%, or is it growing at 3% and it goes down to 2%? The market will move on either one of those. Right now, if you look at these GDP reports, the economy's decelerating. Now, you may say, well, then it's got to be going down. But the thing is, if you go back and look at 2005, that time frame, it was a similar occurrence where it was going down a little bit and then eventually reaccelerated, and the stock market did fine during that time frame. In addition, we had that low volatility like we have now. So we could be in a time frame like that. But look, we have good economic reports coming out. The initial jobless claims, which were a little worse than expected this morning. But if you look at like a 10-week moving average, very correlated to the stock market, it's going in the right direction. Yes, we don't have all the the jobs we would want. We don't have the great quality jobs. We don't have enough jobs, but it's enough to get the trend going in the right direction and for stocks to go up. And so that's encouraging. And we've had, obviously China's reaccelerating. We've talked about that. So we've had some good news lately. And the thing is, we have to be conscious of kind of what could go wrong. And first of all, if we see narrowing, if we see the financials roll over, the transports roll over, and you start going, uh-oh, those were all the things that were working. When you look at financials, which I'm still long financials have been working, right? Semiconductors have been working. Transports have been working. Healthcare has been working. So you have all these areas that are working, and that's what you want. You want a market that's spreading out. Good breadth, they call it. Well, we're having that. If you see that contract, that's something we would watch for to say, hey, something's going on if not everybody's playing in the game here. And then also, obviously, we have oil approaching $100 a barrel. And, $98 as of yesterday, looks like it's going to 100, potentially beyond. Generally, that's considered a good thing, right? That means the economy's growing, oil's going up. But in this fragile economy, is there a potential for that to turn into a negative where it basically just starts hampering the consumer, because the consumer's been spending? Will $100 oil hurt them? And remember, personal consumption last quarter was pretty good, but that was when oil was 85. Now it's 100. So we got to watch that. So the health of the consumer is important. We also have to be watching what the Fed's doing. And I think with the negative GDP print we had yesterday, and again the jobs mediocre, and that Fed already telling us what they're going to do, they're still in the game. Okay, they're still buying their bonds. We can see what they're doing. We watch their actions through looking at the reserves and looking at the monetary base and looking at all this, frankly, kind of boring stuff if you're not into that. Exciting from a nerd like me. But anyways, if you're into that, great. But here's the deal. All that stuff, we can see what they're doing. So they may have dissenters, and they may say, we're going to be tough, and we're going to do this when the time comes. I don't think they're going anywhere right now. I think they're going to continue to buy bonds, keep interest rates low on the short end of the curve as much as they can. But if the market senses that they're going to start letting their foot off the accelerator, then the market may be in trouble. Lastly, obviously, we got March 1st, and that's when the spending cuts are scheduled. The automatic spending cuts are scheduled to occur. Again, threatens our economy, threatens our stock market. So between now and then, the stock market's been ignoring it, but between now and then, here we are almost in February tomorrow. We're going to start seeing potentially that debate heat up and the market get a little jittery. So, but for the time being right now, look, don't go whole hog in. Things are on the upper end here. Don't try to get, the week ago's gains. Those are behind you now. Let the market come in a little bit, or at least move sideways to where some of these indicators come down a little bit. But pick your battles. If you're wanting, if you're wanting a stock like Facebook. Facebook came out with earnings yesterday, better than expected, but the street didn't like what they were talking about. Potentially with some of their, I don't know. I didn't listen to the call, but somebody didn't like something, right? So the stock's down about 5.5% as I speak. If you're wanting that, good. It's better today than it was a week ago to buy it. Those are the types of things you have to do in this market. But if you're, again, wanting to get in and feeling frustrated because it's not coming back, average in. Have your game plan already laid out. And that's what I'm doing. That's what I'm going to be doing, is average in. As long as I see the demand stay strong for this market and nobody willing to sell and the economic news coming in better, that's what I'm going to do. But we have to watch out for those other things in the horizon that are coming up, in the next few weeks as potential signs to get more defensive. But it's again, until that happens or we see any signs of that, you should be more invested in this market and a little more on the bullish side, or at least getting more invested and not necessarily playing complete defense, because the people that played defense didn't do as well last year. And that was because people were worried about the election. They were worried about Europe. They were worried about the fiscal cliff. They were worried about the Mayan calendar. All those things are behind them now. And so I think that's why you're seeing this money come back in the market. So, again, don't get overzealous one way or the other, but I do think I'm still leaning towards the bullish side. All right, guys, just over 10 minutes here. Thanks for following. Don't forget twitter.com/Karl Eggers, Google+, Facebook, eggerscapital.com. Also, we're on iTunes. If you want to subscribe to the podcast on iTunes, you can do that. We've been on there for a long time. Just always forget to mention it. All right, guys. Take care. Have a good day.